Singapore Airlines just dropped a bombshell with its latest earnings report, and it's sending shockwaves through the aviation industry. The carrier, once flying high, has reported a staggering 82% plunge in its second quarter profits. So, what on earth happened? Is this a sign of turbulence ahead for one of the world's most prestigious airlines? Let's break it all down. On the surface, things didn't look too bad. Revenue came in at 4.89 billion Singapore dollars, just a fraction shy of the expected 4.94 billion. That's pretty close. But the real story is in the net profit. Analysts were forecasting a healthy 181 million Singapore dollars. The actual number, a mere 52 million. That's a huge miss, and it's a figure that makes investors very, very nervous. It also dragged down the first half profit to just $239 million, and nearly 68% drop from the same period last year. So where did all the money go? Well, there were a couple of key culprits. First, interest income took a hit, dropping by 42 million Singapore dollars. This was due to the airline having less cash on hand and facing lower interest rates. But the real heavyweight pulling the numbers down is a big bet the airline made on the Indian market. Remember back in November 2024 when Singapore Airlines or CAL merged its Vistara venture with Air India? CAL took a 25.1% stake in the newly combined entity, partnering with India's massive Tata Sons. The vision was grand, to create a dominant force in the rapidly growing Indian aviation market. But so far, that vision is proving to be incredibly expensive. In this quarter alone, associated companies, with Air India being the main one, posted a combined loss of a whopping 295 million Singapore dollars. That's a massive hole in the balance sheet. Sullivan acknowledged this in their statement, saying that despite the ongoing challenges, they remain committed to working with Tata to support Air India's long-term transformation. This isn't the first time Air India has been a drag on SIA's results either. The previous quarter also saw a similar impact. The situation with Air India is complex, following a tragic crash in June that killed over 240 passengers. The airline is reportedly seeking at least $1.1 billion in financial aid from its owners, Tata and Singapore Airlines. This money isn't just to stay afloat. It's earmarked for crucial system upgrades and for building up in-house engineering and maintenance capabilities. Any financial support would be proportional to ownership, meaning CAL is on the hook for a significant chunk of that cash infusion. This is a classic case of short-term pain for long-term gain, but the short-term pain is proving to be very, very acute. The idea behind the Air India investment is strategic. India is one of the fastest growing aviation markets in the world, with a burgeoning middle class eager to travel. By getting a significant piece of Air India, CAL positioned itself to capitalize on this growth. They're not just an investor. They're a partner in a multi-year transformation program aimed at turning the once struggling national carrier into a world-class airline. This involves modernizing the fleet, improving service standards, and streamlining operations. But turning around an airline of that size is a monumental task that requires immense capital and patience. Right now, shareholders are seeing the costs, but the rewards are still years away. While the Air India venture is causing headaches, Singapore Airlines isn't just sitting still. They're actively expanding their network and partnerships elsewhere to strengthen their global footprint. Just this September, they launched new codeshare services with Vietnam Airlines. This move bolsters their presence in the highly competitive Southeast Asian market, offering more routes and connectivity for passengers traveling within the region. Then, in October, they deepened their joint venture with the Lufthansa Group, a major player in European aviation. They added Brussels Airlines to their partnership, which significantly improves connections between Europe and Asia. These kinds of partnerships are vital. They allow airlines to sell tickets on each other's flights, expanding their reach without the massive cost of launching new routes themselves. It's a smart way to compete and offer customers more options, which is crucial in today's interconnected world. So what does the future hold? Looking ahead to the busy third quarter holiday season, the airline says demand for air travel remains resilient. People are still booking flights for holidays and business, which is a positive sign. The post-pandemic travel boom, while maybe not as frantic as it once was, hasn't disappeared. However, the airline is also sounding a note of caution. The global landscape is filled with uncertainty. They point to several challenges on the horizon: geopolitical tensions, which can disrupt routes and affect fuel prices; macroeconomic headwinds, like inflation and potential recessions that could squeeze household budgets; and persistent supply chain constraints, which can delay the delivery of new aircraft and spare parts. And let's not forget the air cargo market. During the pandemic, cargo was a lifeline for many airlines, bringing in record revenue when passenger planes were grounded. But now, that market is much more uncertain. Shifting trade policies and general market volatility are making it difficult to predict future demand. This means that a key revenue stream that helped airlines weather the storm is now less reliable. In their own words, the airline industry continues to face challenges from geopolitical tensions, macroeconomic headwinds, inflationary cost pressures, and supply chain constraints. This is a sober assessment from a company known for its meticulous planning and operational excellence. So, to sum it all up, Singapore Airlines is navigating some serious turbulence. The massive bet on Air India is proving to be a significant short-term financial drain, wiping out a huge portion of their profits. While the long-term strategic goal in India makes sense, the immediate cost is staggering and is clearly spooking the market. At the same time, the airline is making smart moves to strengthen its network through partnerships with carriers like Vietnam Airlines and the Lufthansa Group. The good news is that people still want to fly. The core business of carrying passengers remains strong, but the airline is operating in a very challenging environment. It's a delicate balancing act, managing the costly turnaround of Air India while navigating global economic uncertainties and maintaining its own reputation for quality and profitability. The next few quarters will be critical in showing whether their big Indian gamble will start to pay off or continue to drag down their bottom line. It's a high-stakes strategy, and the entire aviation world is watching. What do you think about Singapore Airlines' strategy? Is the Air India investment a brilliant long-term play or a costly mistake? Let me know your thoughts in the comments below. Thanks so much for watching, and if you found this breakdown helpful, be sure to like this video and subscribe for more deep dives into the world of aviation and business. See you next time!